Every major shift in financial history starts the same way quietly. No alarms, no headlines, no panic. Just a subtle move by someone who understands the game better than anyone else in the room. And this time, the quiet signal came from Stanley Druckenmiller, the billionaire trader who hasn't had a losing year in over 3 decades. When he unexpectedly sold one of the most iconic stocks of this generation, Nvidia, he didn't warn anyone. He didn't give a dramatic speech. He didn't talk about bubbles or fear. He simply exited. And for someone like Druckenmiller, who predicted the AI boom before it became a global obsession, this exit isn't random. It's not emotional. And it's definitely not the kind of move you ignore. To understand why, you first have to understand how Druckenmiller plays the game. Unlike most investors, he isn't trying to predict quarterly earnings or guess next month's stock move. He sees financial markets the way a chess grandmaster sees a board, not piece by piece, but as a living system where every move triggers another. When he makes a decision, it isn't about one company. It's about the entire macro landscape shifting beneath it. His Nvidia investment wasn't a gamble. It was a macro thesis. A thesis that the world was about to enter the biggest computational revolution since the creation of the internet. For years, he talked about how artificial intelligence would reshape global economics, productivity, warfare, medicine, and the way people interact with everything around them. And Nvidia, he believed, was supplying the raw power for that transformation. But here's something most people never knew: Druckenmiller didn't buy Nvidia because he believed in a single company. He bought it because he believed we were standing at the base of an exponential curve, a once-in-a-generation transformation that would require more computing power than any era in history. Nvidia just happened to be the company building the engines for that revolution. He got in early. He rode the most explosive phase, and then he stepped aside. The question is why? To see the answer, you have to go back to 2020. While the world was panicking, Druckenmiller was watching something else entirely. Not the lockdowns, not the stimulus checks, not the broken supply chains. He was watching something almost invisible: a silent surge in demand for specialized chips, data center expansions, and AI-focused infrastructure spending. While most investors thought tech was overheating, Druckenmiller noticed something very different: that the world wasn't shifting to digital, it was shifting to intelligent. He saw companies pouring tens of billions into training models, automating their internal operations, and hiring AI researchers at a scale the public couldn't comprehend. Even during the recession fears, AI budgets didn't shrink, they grew. Behind every headline about inflation or unemployment, something massive was building in the background. And while everyone else was trying to figure out whether Zoom and Peloton were temporary bubbles, Druckenmiller was already tracking the next phase of human computing, a world where every industry would rely on machine intelligence the way it relies on electricity. A world where GPUs became the new gold. When he bought Nvidia, Wall Street still treated AI like a tech story. Druckenmiller treated it like an industrial revolution. But here's where the story becomes fascinating. For most people, Nvidia is the AI story. For Druckenmiller, Nvidia was just chapter 1, because he understands something that retail investors often forget. Every technological revolution has 2 phases. The first phase is explosive. It's full of hype, rapid adoption, and sudden surges in demand. The second phase is different, deeper, quieter, more competitive, and less predictable. The players change. The profit pools shift. The infrastructure reshapes itself. The mistake most investors make is assuming the first phase lasts forever. Druckenmiller never makes that mistake. The AI boom's first chapter, the training era, was Nvidia's absolute domain. Every model, every breakthrough, every AI product depended on GPUs. The world couldn't get enough. Companies begged for supply. Nvidia couldn't build chips fast enough. It was a once-in-a-century moment. But Druckenmiller knows what comes next. And the next chapter isn't built on the same economics. The next chapter is inference. The moment where AI stops being trained in secret data centers and starts running in the real world, in factories, in hospitals, in self-driving cars, in consumer devices, in smartphones, in robotics, in everything. And the chips powering that world aren't the same chips powering the training boom. The margins are different. The supply chain is different. The competition is different. The winners are different. Nvidia will remain huge, but its dominance won't look the same. Druckenmiller didn't exit because the AI revolution is over. He exited because the AI revolution is changing shape. That's the difference between a trader and a visionary. Most people invest in what they can see. Druckenmiller invests in what's coming after what they can see. Think of it like the early days of the internet. In the 1990s, the biggest winners were companies selling hardware and routers, the infrastructure providers. But the next decade's biggest winners were software platforms, search engines, and cloud companies. The winners changed. The power shifted. The value migrated upward. Druckenmiller senses that same shift beginning inside the AI world. But there's another layer to his exit, one far more macro. For the last 2 years, global liquidity has been tightening. Interest rates have hit levels not seen in over 2 decades. Government borrowing costs are rising. Corporate debt is piling up. The consumer is showing signs of fatigue. And in this environment, even the most beloved companies eventually face pressure. Nvidia didn't feel that pressure yet because its growth was supernatural, too powerful to slow down. But Druckenmiller knows what happens when a company's growth rate begins normalizing, not collapsing, just normalizing. When a company has become so enormous, so widely owned, so universally expected to grow forever, even a slight deceleration can trigger a correction. He's seen it before. He watched it happen in the dot-com bubble. He watched it happen with housing in 2007. He watched it happen with crypto in 2021. He knows the pattern. When expectations become flawless, risk becomes invisible, and that's when smart investors exit. But perhaps the most important piece of this puzzle is a single line Druckenmiller said in an interview that most people ignored. He said, "I still believe in AI. I still believe it will change everything. But at some point, you have to ask yourself how much of that change is already priced in." That sentence tells you everything. Druckenmiller didn't exit Nvidia because the company is weak. He exited because the story is too strong. A perfect story is the most dangerous story in finance. It pushes valuations beyond fundamentals. It attracts blind capital. It convinces average investors that the ride will last forever. And eventually it creates a gap between expectations and reality. Druckenmiller doesn't wait for that gap to close. He exits before the crowd even notices it exists. His exit isn't a criticism of Nvidia. It's a warning about the next phase of the cycle. But the most intriguing part of all this is what Druckenmiller is accumulating now. Because his investments today reveal what he believes is coming tomorrow. He's moving into companies building the next AI infrastructure layer, not training chips, but energy systems, semiconductor materials, networking bandwidth, optical technology, edge, device inference, and next-generation compute architecture. He sees something most people haven't realized yet. The AI revolution isn't slowing down. It's accelerating, but its center of gravity is shifting. Nvidia dominated the training era. The next era may have different winners, different margins, different bottlenecks, different technologies. Druckenmiller isn't betting against AI. He's betting on the evolution of AI, and his Nvidia exit is the first major public signal that the next chapter of this technological revolution has begun. But to truly understand the deeper implication of Druckenmiller's move, you have to step back and look at the entire architecture of the AI ecosystem. Not just the companies at the top, but the energy beneath them, the materials behind them, the governments funding them, and the geopolitical forces shaping them. Because the next phase of AI won't be defined by who sells the most GPUs. It will be defined by who controls the pipes, the power, and the pathways that make intelligence possible. And quietly, in the background, the balance of those forces is changing. Behind every AI model is a simple truth: intelligence requires energy. Enormous amounts of it. Data centers aren't just buildings full of chips, they are industrial power plants disguised as warehouses. And while the world has been celebrating the rise of artificial intelligence, few have noticed the growing tension between compute demand and the global energy grid. Druckenmiller has, because long before Nvidia's stock hit its peak, he was studying something else entirely: the exponential strain that AI is placing on electricity systems across the US, Europe, and Asia. He saw power companies warning that they could no longer meet the demands of upcoming AI clusters. He saw governments quietly scrambling to secure energy sources. He saw utility CEOs publicly stating that data centers were consuming power at a rate they couldn't sustain. And he saw something the market ignored in a world where AI demand doubles every few months. The bottleneck isn't chips. It's power. This is where Druckenmiller's thinking is fundamentally different from Wall Street's. Everyone else is focused on the end product. The AI, the breakthroughs, the applications, the companies promising a smarter world. But Druckenmiller looks at the foundation underneath that world. He looks at what fails first, not what succeeds first. And right now, he sees enormous pressure building in the infrastructure layer. The more intelligence we create, the more power we need. And that imbalance, if left unchecked, will reshape the entire investment landscape. It's the same intuition that led him to see the housing crisis before it broke, the tech crash before it burst, and the pandemic-induced inflation before central banks even admitted it was real. He understands that every boom carries the seeds of its own constraint. And in the AI boom, that constraint is starting to appear, not in Nvidia's earnings, not in chip demand, but in the physical limitations of the energy grid itself. That's why his portfolio moves away from Nvidia aren't a retreat from technology. They're a redirection toward the systems that AI depends on. He's moving into companies involved in energy distribution, grid modernization, semiconductor materials, advanced networking, and even firms specializing in the cooling systems required to keep AI models from overheating. These aren't headline-making investments. They aren't flashy. They don't trend on Twitter. But they are the scaffolding of the next phase of AI. Because in Druckenmiller's world, the real opportunity isn't where the spotlight is shining. It's where the spotlight is going to move next. This brings us to something even more powerful: competition. Not human competition. Corporate competition, model competition, silicon competition. Every major technology cycle moves through phases of monopoly followed by fragmentation. Nvidia's monopoly in the training era was one of the strongest in history. But Druckenmiller knows that monopolies never last long in hyper-growth growth industries. He's already seeing the fault lines forming. Governments are pouring billions into domestic chip development to reduce reliance on foreign suppliers. Tech giants are designing custom AI chips to lower costs and reduce bottlenecks. Startups are building specialized silicon optimized for inference rather than training. Cloud companies want more control over their compute stack. Even the AI labs themselves, OpenAI, Anthropic, Google DeepMind, are beginning to explore custom hardware paths. Druckenmiller knows how these patterns unfold. When too much value concentrates in one company's hands, the rest of the industry shifts aggressively to reclaim power. It's not personal. It's evolutionary. It happened to IBM. It happened to Intel. It happened to Cisco, and now he sees it beginning around Nvidia. This isn't a collapse story. It's a migration story, the kind only someone with decades of macro experience can anticipate. Nvidia will remain a giant, but the edges of its dominance will slowly erode as the ecosystem diversifies. And then there's the final layer, human behavior. Druckenmiller knows that markets don't react to numbers, they react to crowds. Crowds that get excited, crowds that get scared, crowds that convince themselves that a single company will grow forever. When Nvidia became the third largest company in the world, passing giants that took decades to build, he recognized something investors hate to admit: psychology had taken over. The company was still executing perfectly, but expectations had become supernatural. He's seen this story before. He saw it when investors believed tech stocks would double forever in 1999. He saw it when homeowners believed property prices never fall in 2006. He saw it when crypto traders believed Bitcoin would hit 500,000 in 2021. Every time the same thing happened, expectations climbed far beyond fundamentals, and eventually gravity returned. Druckenmiller doesn't bet on gravity. He simply respects it. And yet, what makes his Nvidia exit even more fascinating is what he didn't do. He didn't short the stock. He didn't warn about a bubble. He didn't publicly criticize its valuation. He didn't signal fear. He simply took profits, enormous profits, and looked forward. That's the mark of a disciplined trader who doesn't confuse brilliance with luck. He knows that no matter how extraordinary a company is, no company can rise in a straight line forever. But his exit also sends a deeper message, not about Nvidia, but about the entire structure of the AI revolution. He believes the world is entering a more complex, more competitive, more resource-constrained phase of technological growth. A phase where winners won't be determined by hype, but by fundamentals: energy, hardware efficiency, network capacity, supply chain resilience, and real-world adoption. In this environment, the market's obsession with Nvidia is blinding investors to the second and third-order opportunities emerging beneath the surface. Druckenmiller isn't leaving AI. He's positioning himself for the next derivative wave of AI, the companies and technologies that will benefit when the hype settles and the infrastructure era begins. And behind all of this, there is an even quieter signal, something that rarely gets discussed outside elite investment circles. Druckenmiller is increasingly focused on geopolitical tension surrounding semiconductor production. Taiwan, home to the world's most advanced chip factories, sits at the center of a rising conflict between China and the West. Any disruption in the region could reshape the global supply chain overnight. Druckenmiller understands that geopolitical risk isn't theoretical, it's structural. And he doesn't want his capital tied to any single point of vulnerability. His Nvidia exit isn't fear, it's preparation. Preparation for a world where demand for intelligence is infinite, but the systems required to support it are strained, competitive, and fragile. A world where the next wave of winners won't be the companies selling the picks and shovels of the gold rush, but the companies redesigning the mines. And this leads to the final truth underlying his decision: the AI revolution is just beginning, but its map is changing. Most investors are still chasing the first chapter. Druckenmiller is already reading the next one. But there is one more layer to Druckenmiller's Nvidia exit. The part of the story that almost no one notices because it doesn't show up in filings, interviews, or stock charts. It shows up in timing. Because if you look closely, Druckenmiller always exits when a narrative shifts from misunderstood opportunity to mainstream certainty. He makes money in the quiet phase, not the loud one. When he first bought Nvidia, AI was a bold theory. Only scientists and a few visionary investors were talking about transformer models, neural scaling laws, and the future of machine cognition. But today, AI headlines dominate every newspaper. Every CEO mentions AI in earnings calls. Governments are drafting AI laws. Even high school students are training models on their laptops. AI isn't a mystery anymore. It's a global obsession. And when something becomes an obsession, it also becomes a trap. It's the same pattern that played out with cloud computing, electric vehicles, biotech, blockchain, the VR. The moment a technology becomes part of mainstream culture, the market overrepresents the present and underestimates the future. It prices in perfection. It prices in hype. It prices in fantasy. And that's when someone like Druckenmiller, who has survived every major cycle for 40 years, quietly steps away. But stepping away doesn't mean giving up. It means repositioning. Real wealth in technological revolutions is rarely made by holding the same company forever. It's made by anticipating the turning points. The moments when the curve bends, when the bottleneck shifts, when the value migrates from one layer of the ecosystem to another. Druckenmiller isn't exiting the AI revolution. He is catching the next wave before the world realizes it exists. And that next wave has three pillars, three forces quietly shaping the future of artificial intelligence. The first is compute efficiency. Training the world's largest models used to require brute force power, massive GPU clusters, endless electricity, and gigantic data centers. But as models mature, efficiency becomes the new frontier. Companies are racing to design chips that use fewer resources, accelerate inference, and compress computation without losing accuracy. These aren't chips meant to power scientific breakthroughs. They're chips meant to power the real world, autonomous factories, logistics systems, medical diagnostics, financial modeling, robotics, defense systems, and everyday consumer devices. Druckenmiller understands that the winners of the efficiency era won't be decided by hype. They'll be decided by physics. The companies that master the relationship between intelligence and energy will define the next decade. The second pillar is decentralization. Right now, AI lives inside massive centralized clusters built by Microsoft, Google, Amazon, and OpenAI. But as the world demands faster, more private, more secure intelligence, computation will migrate outward, toward the edge. Cars will run their own models. Phones will process intelligence on device. Factories will make real-time decisions without pinging a cloud server. Homes, appliances, security systems, wearables, medical devices, all of them will need chips optimized for inference, privacy, and speed. This shift isn't just technological, it's economic. The companies that master edge AI will power the next trillion-dollar market. The third pillar is geopolitical control. Nations are beginning to realize that AI isn't just a technology, it's a form of national power. The countries that control the flow of compute, the supply chain of chips, and the regulation of models will shape the global balance of power. China is racing to build domestic AI infrastructure. The US is pouring billions into local semiconductor manufacturing. Europe is fighting to avoid dependence on foreign tech giants. Even smaller nations are carving out compute strategies in fear of being left behind. Druckenmiller sees this geopolitical AI race not as a threat, but as a once-in-a-lifetime capital flow. Governments will spend unimaginable amounts to secure computing power, chip sovereignty, energy supply, and AI infrastructure. And wherever governments spend, investors make money. These three pillars, efficiency, decentralization, and geopolitics, are the foundations of the next phase of AI. And this is where Druckenmiller is positioning himself. Not in the companies that dominated the first phase, but in the companies that will dominate the next. Companies that generate the power, build the cooling systems, engineer the custom silicon, create the networking backbone, design the edge devices, and manage the flow of intelligence between humans, machines, and nations. And when you see the world through this lens, his Nvidia exit stops looking like a warning and starts looking like a blueprint. It is the same blueprint he followed when he exited tech stocks in 1999, right before the dot-com bubble burst. The same blueprint he used when he exited housing-related assets in 2006, long before the crash. The same blueprint he followed when he bought Bitcoin before institutions understood it, then reduced exposure when the fever took over. He isn't reacting to markets. He's forecasting them, months, sometimes years ahead, but there is still one question left. The question that ties this entire story together. If Druckenmiller saw the AI boom coming before almost anyone, why would he leave before it fully matures? The answer is simple, because the greatest investors in history don't get paid for being right. They get paid for being early. Being early means buying before the world understands. Being early means selling before the world catches up. Being early means protecting capital from the blindness of the crowd. And that's exactly what Druckenmiller is doing. He knows Nvidia will continue to innovate, continue to lead, and continue to shape the future of AI. But he also knows that the next $1 trillion of opportunity won't look like the first trillion. It won't come from GPUs alone. It will come from the global transformation required to support intelligence at scale, the transformation happening under the surface. Nvidia built the engines, now the world needs the infrastructure. Druckenmiller is investing in the highways, not the car that made everyone excited about driving. In the end, the real lesson behind his Nvidia exit isn't about a stock. It's about understanding cycles, economic cycles, technology cycles, psychological cycles, and human cycles. It's about recognizing that the market isn't a straight line, it's a set of waves. And the people who survive the longest are the ones who learn to move with those waves instead of fighting them. Druckenmiller isn't abandoning AI, he's evolving with it. He's preparing for a world where intelligence is everywhere, embedded in every device, every transaction, every national strategy, every layer of society. He's preparing for the era after hype, the era of reality. And when the history of this technological revolution is written, people will look back and realize that the moment Druckenmiller sold Nvidia wasn't a sign of weakness. It was a sign of foresight. The kind that only comes from decades of navigating markets that never move in a straight line. Markets shaped by innovation, fear, greed, hope, and the unstoppable force of human ambition. Most investors are still asking why he sold. But the question they should be asking is, what does Stanley Druckenmiller see that the rest of the world hasn't noticed yet? Because whatever that is, that's where the next great opportunity lies. The strangest thing about Stanley Druckenmiller's decision wasn't that he sold Nvidia. It wasn't even the timing. It was how quiet he became afterward. For a man who never hesitated to break down the logic behind his trades, this silence seemed deliberate, almost calculated. Because the deeper you look into the landscape he is navigating, the more you realize that Druckenmiller likely didn't sell Nvidia because something was wrong with the company. He sold because something is shifting around the company. Something bigger than sentiment, bigger than valuations, and bigger than the AI boom itself. For months, he had watched a single chart more obsessively than Nvidia's stock price, the chart of capital expenditures across the world's largest tech firms. Amazon, Google, Meta, Microsoft, even Tesla, all pushing billions into AI infrastructure at a pace far outstripping revenue gains. It reminded him of a familiar story, the dot-com bubble. A time when companies weren't lying, but they weren't telling the whole truth either. They believed the future would arrive faster than it actually could. And when expectations outrun reality, capital evaporated. Not because the technology was fake, but because the timeline was wrong. He had seen the same psychological pattern forming here. The market was no longer pricing Nvidia based on earnings, it was pricing it based on destiny. The belief that every company on Earth would rebuild itself around AI overnight. But destiny trades only work when the world rewrites itself as fast as investors expect. Druckenmiller knew better. He knew that the world always changes slower than the people betting on it. And that lag, that delay, is where most fortunes are lost. But that wasn't the only thing he saw. Behind the scenes, something else was unfolding, something few retail investors ever hear about: the scramble for energy. AI infrastructure wasn't limited by GPUs, it was limited by electricity. Data centers were running into capacity ceilings. Servers were overheating. Utilities were warning that power grids couldn't scale at the pace Silicon Valley was demanding. To build the AI world the market was pricing in, the US would need energy production equivalent to a small country. And not in 20 years, in the next 5. Druckenmiller knew this bottleneck would slow the boom. Not kill it, just slow it, yet slowing was enough. Because Nvidia's stock wasn't priced for slowing, it was priced for acceleration. Eternal acceleration, the kind that never happens in real economies. As he explained to one colleague, AI is not a bubble, but the belief that every company can adopt it instantly, that's the bubble. But there was one more reason he stepped aside, the most important of all, and it had nothing to do with Nvidia or AI. It was interest rates. For the first time in nearly 2 decades, money wasn't free anymore. Borrowing wasn't free. Expansion wasn't free. Entire business models built on low-rate assumptions were now failing silently one by one. Venture capital funds couldn't raise. Startups couldn't refinance. Tech companies couldn't justify moonshot investments without shareholder pressure building behind them. People forget this: Nvidia's world doesn't run only on GPUs. It runs on cheap liquidity, on capital that can be deployed aggressively without fear of debt costs. Druckenmiller understood that as liquidity drains, growth stocks, even the best growth stocks, begin to behave differently. They breathe differently. They respond more violently to macro tremors. And the macro tremors were getting louder. One tremor stood above the rest: the US debt crisis. For months, Treasury auctions were showing cracks. Foreign buyers were stepping back. Bond demand was weakening. Yields were staying high even when inflation fell. A sign that markets didn't trust the government's long-term fiscal path. Druckenmiller had warned about this for years. Too much debt means too much risk and too little flexibility. And when governments lose flexibility, markets lose certainty. He wasn't predicting a crash. He was anticipating turbulence, the kind of turbulence that crushes over owned trades. And Nvidia was the most owned trade in the world. What made his decision even more revealing was the fact that he didn't move to a bearish position. He didn't short Nvidia. He didn't bet against the AI future. He simply stepped aside. That's the hallmark of a veteran who understands how markets behave in late cycles. When optimism becomes universal, even good news becomes insufficient. Even great companies become vulnerable, not because they fail, but because expectations rise faster than reality can deliver. A friend once described Druckenmiller's ability as the rare talent to see the movie 2 scenes ahead while everyone else is reacting to the last frame. That's exactly what he was doing here. As the months progressed, he watched something subtle but important unfold: institutions quietly trimming exposure to the AI trade. Not because they stopped believing in it, but because their allocation models demanded balance. When one stock becomes responsible for too much of your portfolio's returns, it becomes a single point of failure. Nvidia had become that point of failure. And then came the moment almost no one noticed: a shift in language among CEOs. In earnings calls, the tone shifted from "we are rapidly expanding AI spending" to "we are optimizing costs and improving efficiency." When companies start talking about optimization, it means the phase of reckless investment is cooling. Druckenmiller recognized this instantly. It was the same pivot that happened during the cloud boom, during the smartphone boom, during the EV boom. Every transformational technology goes through periods of digestion, periods where the world has to absorb what has already been built before more growth can come. Investors rarely understand this. They confuse digestion with decline. Druckenmiller did not. He simply understood that digestion creates volatility, the kind of volatility that eats over-leveraged positions alive. But Nvidia wasn't the only thing he was watching. He was analyzing what happens when a single company grows so dominant it begins to distort the broader market structure. The S&P 500 was being heavily skewed by Nvidia's weight. Hedge funds were forced to own it. Index funds were forced to own it. Pension funds were forced to own it. His conclusion was simple. When everyone owns the same idea, the exit becomes the real risk. That was the moment he made his final decision. He would rather miss the next leg up than be trapped in the world's most crowded trade during a period of tightening liquidity, slowing capital expenditure growth, energy shortages, and rising interest rate pressure. It wasn't fear, it was discipline. The discipline of someone who survived Black Monday, the dot-com crash, the great financial crisis, the taper tantrum, and every liquidity shock in between. By selling Nvidia, Druckenmiller wasn't declaring the end of the AI age. He was declaring the end of the first phase, the euphoria phase. The phase where belief outruns math. The phase where markets forget that the future takes time to build. And now, as he steps back, he waits for the next phase, the phase where real winners emerge not from hype, but from economic gravity. No one knows exactly what he's planning next. But history offers a clue. He always returns. He always strikes when the imbalance flips. When markets swing from overconfidence to disbelief. When the world stops dreaming and starts doubting. Because that's when the greatest opportunities appear. And perhaps that is the real lesson hidden behind his Nvidia exit. Not that he lost faith in AI, but that he still believes in cycles. That even the most powerful megatrends breathe in and out. That every boom needs a reset. And that stepping aside at the height of excitement isn't cowardice, it's mastery. Most investors spend their lives chasing the last move. Druckenmiller built his legacy by preparing for the next one. And once again, he may be positioning himself not for the world everyone sees today, but for the world that's already forming quietly behind it. Because if history proves anything, it's this: he never walks away without knowing exactly what he'll return for.